All right, so thank you, Jeff, and thanks everyone for having us and for the opportunity to talk through this this topic with you all. So my name is Matt Cropp. I'm the executive director of the Vermont Employee Ownership Center. I've been with the organization since 2014, and we do a lot of work around ownership succession, as well as an increasing amount with startups thinking about how to share ownership broadly with their employee group. So I'm going to screen share now the sort of slides I've put together, and we'll kind of work through those. We'll hear a little story from Nick, talking a little bit about their experience with employee ownership at Stone Environmental, and then we'll keep some time open at the end for questions. And if there's any questions that come up as we sort of walk through the slides, feel free to throw them in the chat, and then we can kind of keep them on the list for discussion at the end. So with that, I will share my screen. So I'll start by introducing kind of broad-based employee ownership and what we mean by that, and some of the things that kind of tie all the different models together. Then we'll go into a couple of the most common models for broad-based employee ownership. Have the just kind of case study discussion of what that looks like at Stone Environmental, and then dig into the questions and discussion. So at the Employee Ownership Center, when we talk about broad-based employee ownership, we're meaning something somewhat specific. So there's a whole universe of ways that you can share ownership with employees at a business. Everything from profit sharing, or if you think of ownership as having kind of the pieces of a share of profit and potentially some control over the business, you can break that into different pieces. There's companies that do profit sharing, there's companies that do stock options or phantom stock, phantom equity. There's many different forms of equity compensation. So what we're talking about today is a little bit narrower. So ownership of a business directly or indirectly, and part or in whole, by sort of all the employees, including non-managerial employees. So this is different than, say, giving a few key managers a little bit of equity or something like that, but creating systems where everyone who's been there, who's there full time, can they don't necessarily get it walking in the door, but have a path to becoming a co-owner of the business over time. Well, let me just double check, make sure we have no one in the waiting room here. No, good. When we're thinking about common forms of this kind of broad-based employee ownership, there's three main ones that we work with, and then there's some interesting ones that are kind of bespoke as well. And I can talk a little bit about that, but probably the most well-known example in Vermont is Cropp Technology, which has kind of a unique form of stock ownership where they essentially just grant shares to their employees every year, kind of diluting over time. So again, plenty of room for creativity, but these are the three major models that we work with: employee stock ownership plan, worker cooperative, and more recently, we're seeing kind of the emergence of the use of what's being referred to as employee ownership trusts. So when we're thinking about like why broad-based employee ownership can be important, there's a number of elements, and I'll hit on kind of a few of the high-level ones, but you can kind of really drill down on this further. So from the perspective of it being a way to exit ownership of a business, right? So a business owner has built a business, they want to sell their business. They think about, do I sell to an outsider? Do I sell to various groups of people? There's a few kind of advantages to be aware of for selling your business to the employees. The first is the idea that you can create an internal market for the owner's shares. So rather than having to go out on the open market and find a buyer and figure out their timing, you can kind of time your exit accordingly and decide, okay, well, maybe this year isn't the year to do it. I want to build the business a little bit more. And you can sell generally, chunks over time, or do it all at once. And there's reasons to do that in various ways. But there are some tax rules that we'll get into about that kind of, that can also shift the balance in terms of, how profitable it is to sell to the employees versus other groups. Another big motivation that we see is kind of legacy preservation, right? So kind of the question of, okay, well, as a business owner, you put a lot of your identity, your efforts, blood, sweat, and tears into building this business, and what do you want it to be next once you're no longer there? Oftentimes for family businesses, we'll see employee ownership as an alternative to when the next generation doesn't want to take over the business. for businesses that have kind of a strong mission component. Oftentimes, the employee group, and sometimes that can be combined with like B Corp or other types of things, can be a way of sort of picking the stewards of the mission of the business going forward. And there's many other legacy considerations where, as a business owner, folks think about, why am I doing this? And what do I want to see when I'm gone? And this can be an exit that can help in various ways guide the company in its next stage that's in alignment with those legacy goals. And then in terms of, for companies and communities, there's also a bunch of benefits. So one thing that's been shown in numerous studies, and there's a lot of great academic research on this out of Rutgers, particularly, is improved productivity. So when you've got a broad group of people who are all co-owners of the business where they work, they're going to treat their work differently in a variety of ways. And particularly when that ownership is paired with forms of participatory management, information sharing, open book management, that sort of thing. It gives people a line of sight from their particular job to the overall performance of the company, and how that overall performance will come back and benefit them. That's where the magic really happens, and you can see significant productivity improvements kind of on average of companies in a wide variety of sectors. A second piece is talent retention. Employee-owned companies on average have statistically much lower turnover than their peer companies. And part of that is that sort of sharing of wealth, but there's also some cultural elements too that if a company builds a strong ownership culture, it can be something where someone who might be thinking, okay, this is a job for a few years and then I want to go start my own business or something along those lines, instead can see this as a long-term place to build their career and build a life around. And then from community perspective, and this is why there's kind of some policy, both tax-wise and otherwise, to support employee ownership, is one thing is it can, exiting to employee ownership can be a way of preventing, viable businesses from closing due to kind of failed exit planning. Having that employee group that knows the company intimately can be something that helps manage the transition, and it roots companies and communities. So you have a bunch of employee owners, the odds of them saying, all right, well, let's pick up stakes and go to South Carolina because there's some marginal tax incentives to do so. That's going to be a different decision for a group that's owned by 50 folks who all live in a community versus someone who's an external investor who can just kind of make those decisions without regard to sort of the community and livelihood of the folks who work there. And then sort of at sort of a bigger scale, right? Giving kind of a structural opportunity for everyone who works at a company to share in the value the company create broadens capital ownership. So folks who otherwise might have a lot less in terms of savings and personal wealth, they're kind of sharing the wealth being generated by the company where they work. And there's consistent studies show that employees of ESOP companies have more than double the retirement savings of their non-ESOP company peers, and that sort of creates economic security for more people and stabilizes communities in good ways. So the first model we'll talk about today is the employee stock ownership plan. It's been around since the 50s. This economist, Louis Kelso, kind of came up with the model and kind of piloted it first at a newspaper, and then there were a few hundred companies that sort of experimented with this in the 50s and 60s. In 1974, when this kind of landmark pension reform legislation was passed called ERISA, which still governs the retirement system to this day, the ESOP was written in as one form of retirement plan in that system, which gives it some very sort of powerful tax benefits, but also puts it under a fair amount of regulatory scrutiny because it is a retirement plan that's regulated by the Department of Labor. But in any case, by the combination of factors, the number of ESOPs has grown into several thousand, with millions of participants. And there's some that in publicly traded companies, but in this case, we'll be mostly talking about kind of privately traded private companies that are ESOP owned. And there's 29 ESOPs that are headquartered in Vermont. Another number of national companies that are ESOPs also have operations here, but with some fairly recognizable names. Gardeners, we'll be hearing about Stone Environmental, Switchback Brewing, Carriage Reels. There's Vermont Information Processing, et cetera. So the quick overview of how an ESOP works, right, is, as I mentioned, it's a tax qualified retirement plan. It's the only kind that can hold employer stock. So employees don't put any cash down immediately, but rather, directly to buy in, but rather they receive pre-tax employer contributions of up to 25% of payroll to buy company stock that goes into their plan. So each year, the shares, basically the company makes a contribution to the ESOP. The ESOP is used to buy company shares. It's just like other retirement plans, kind of based on compensation. So maybe the company makes a 8% or 10% contribution to the retirement plan. And so someone who's a higher earner is going to get, a larger chunk of stock than a lower earner, up to a maximum of, I think it might be increasing. It's more like 300,000 now. The 275 number might be a little dated, but it kind of, that gradually creeps up each year as other retirement plan kind of maximums are increased. But so that very high earners can't kind of get a hugely disproportionate amount of the stock, and it keeps it somewhat, keeps, again, broad-based employee ownership. Just like with some other retirement plans like 401ks, usually the employees are going to vest into the plan. And so that can be done in a stepped manner where it's 20% a year over 5 years, or in a cliff manner where you work for the company for 3 years and then you're fully vested in your ESOP plan. In terms of governance, there's a lot of diversity in how ESOPs are governed, but the core kind of model is that the trustee has a fiduciary duty to the plan beneficiaries, and is regulated again by the Department of Labor. So if it fails in its duty, there are consequences for the trustee. So the trustee usually votes the shares on behalf of the employees, to elect the board of directors and that sort of thing. There are some ESOPs that allow for more direct governance, around certain decisions, and there's a number of ESOPs kind of experiment with ideas around like having some, making sure that there's some employees from various parts of the company on the board. But there's really a lot of diversity in the ways that they do that. And then in terms of folks leaving the company, the trust repurchases the shares, which are there's a valuation done each year. And it has the ability to do so over time. So it can wait up to 5 years. If someone's not retirement age, it can wait up to 5 years before someone starts being paid out and then pays out over 5 years. Folks at retirement age can exit much quicker. But it's a way of kind of both making sure that there's kind of a medium-term, at least medium-term sense of time horizon on the part of the employee owners, and lets companies kind of manage their cash flow on that. And I see a hand from Julia.
Yeah, Matt, I had a question.
Yep.
This is all really new to me, so I'm trying to learn as much as I can, but some of it's a little confusing. So in the first bullet point, you said that the employer basically, in lieu of like a 401k, the employer would buy shares on behalf of the employees. So do the employees ever buy shares, or is it all gifted to the employees over time?
It's with the ESOP, and we'll get into another model where employees do buy in directly, but with the ESOP, it's all kind of coming from the company as a retirement contribution as part of their compensation package.
Okay.
The many ESOPs will have maybe both an ESOP and a 401k plan that the employee can then make contributions into a diversified 401k, and then they are also building up company stock at the same time.
Okay, great, thanks.
In terms of actually bringing an ESOP into existence, there's a few things to think about on this front. One is scale, because again, it's a retirement plan, and there's some compliance things that have some cost to them that are usually offset by some of the tax benefits. But there's a certain scale at which that offset sort of happens. So I'd say our rule of thumb is when we're talking to companies, you usually need about 20 employees to exit to an ESOP, and about 3 million in enterprise value, and healthy cash flow. So if a company's really struggling, this isn't going to be a silver bullet that is like, all right, we'll write ourselves through the ESOP, but something that's a company that's in good shape. And for startups, generally it's something that you're not going to, unless you're starting up with a good, bit of investment that's okay with this, you're not going to do it in your first year or 2 years. But if you're growing quickly, Gardner Supply, for instance, they created a minority ESOP in their 3rd year of existence, and each year they did kind of a pay-as-you-go type plan to gradually build it up. The cost of creating it, can be substantial initially, where you're talking maybe $100,000, $150,000 in total setup fees, including valuations and the trustee who represents the interests of the plan beneficiaries and a variety of those things. And then there's an annual valuation, plan administration, that sort of stuff. The flip side is, from a tax perspective, for these costs, you have, especially if it's an S Corp ESOP, a lot of companies go that way 100%, because they essentially, if the only owner is this tax preferred retirement plan where the taxes are paid by the beneficiaries when they receive their retirement benefit, there's no tax paid by the corporation, which allows for kind of retaining cash for both paying for some of those costs, paying for repurchasing shares as people leave, that sort of thing. So there's some real tax benefits to that. And so, let's see here. Yep, I can definitely share that recording. So in terms of actually putting an ESOP into place, there's kind of two ways. One is pay as you go, where it's, the company will kind of set it up in years where, in the case of Gardner Supply, right, when they had some years where they were pretty profitable, it was a way of kind of essentially tax efficiently bonusing people little chunks of company ownership. And they gradually, over maybe 15 years, built up a 10 or 11% stake before doing a leverage transaction. The second piece is more of an immediate, going to 100%, and which then allows for kind of those tax benefits to be accessed. And I mentioned the S Corp tax benefit. The other benefit is that if you sell a company to the employees that is a C corporation, to them either as an ESOP or as a worker co-op, which we'll get into next, the seller can reinvest the money almost similar to like a 1031 exchange for real estate and not pay capital gains taxes on that money as long as it's kind of reinvested in the new property. So there's some benefits to doing that immediately from an exit perspective. And it's the only kind of retirement plan that can take on debt. So the ESOP can essentially, in combination with the company, go to a bank or a similar lender and borrow the money necessary to sort of essentially buy out the company, which can then be paid back with these pre-tax dollars that are being contributed. And it's an especially tax efficient way of doing a leverage buyout because you can get a tax benefit, or both the principal and interest is tax deductible, not just the interest. All right, so the next model we work with, and this is something that's, that we often see with much smaller companies, and Vermont has a lot of small companies, so I'd say kind of on average, more, maybe 2 to 3 times the number of companies we talk to are kind of in this range versus in the ESOP range. But it's a worker cooperative, right? And worker co-ops are one form of this broader idea of cooperative businesses. So it's, there's food co-ops, kind of consumer cooperatives, there's producer co-ops, like, say Cabot, farmer cooperatives. And then there's worker cooperatives. And the idea with a worker cooperative, is its membership is limited to those who work in the business. So in this case, members actually do buy a share and are a direct owner of the business. Although, as we'll see, the share is not actually connected to the market valuation of the business to make it accessible to the broad workforce. In terms of governance, members elect the board of directors on the one member, one vote basis, and they share profit on the basis of either hours worked or W-2 income. So it's basically the idea of quantified, a way of like quantifying labor contribution to the company. And management in a worker co-op can be conventional, right? So you have kind of this board of directors, they supervise the CEO and kind of set some policy questions, or it can be flat where you kind of have more of a collegial form of operations. We sometimes see that in like consulting firms, and there are certain alternative management structures that some co-ops do. I'd say the majority tend to be kind of that conventional structure there. And so when thinking about a conventional versus a co-op business, regardless of its type, there's a couple of things to be aware of, just in terms of core differences, right? The first is governance power. So a conventional business, generally governance power is distributed on the basis of capital ownership, right? You own 30% of the company, you have 30% of the votes. With a co-op, it's distributed equally to all members. So you're a member, you get one vote for the board of directors, and that sort of thing. That doesn't necessarily mean management power is on the basis of one member, one vote or anything like that, but it's that sort of governance level. So it's important to distinguish between the governance of the company and the management of the company. And then the second piece is how profit is distributed. So with conventional businesses, right, again, you own 30% of the company. Generally, you have the right to receive 30% of the profit. With co-ops, the core idea is that profits distributed on the basis of the use of the cooperative. And its goal is to operate on a not-for-profit basis towards its members. So when you're thinking about something like a consumer cooperative, the members, basically, if there's a profit at the end of the year, your food co-op or something like that, it's distributed back to members prorated by how many dollars they spent at the cooperative. For producer co-op like Cabot, it's how much milk the company each farmer marketed through the company. And so for a worker co-op, again, it's based on how much labor you contributed. I'd say that probably like 80 to 90% of worker co-ops just use a simple hours worked metric where people will make market rate wages, and then at the end of the year, if there's profits, divided up prorated by hours worked. Some will use W-2 income, which is also allowable, and then means higher earners get a larger share of profit. So there's at the last survey, there's probably 400 to 500 companies in the U.S. that are organized on this basis. There's about 19, or I think there's a new one that just came online, so I think that number is at 20 now. In Vermont, and it's really a wide variety of industries that we see certain clusters, like a lot in design build. I think there's interest there, particularly from a retention perspective, because it's an industry where people will learn the trade and then throw a sticker on the side of their truck and then go into business for themselves. And so having this form of employee ownership gives folks, an alternative path to becoming, a partner in the business essentially. But there's a wide variety of other things. Healthcare, PT 360. There's a private school that's organized on this basis. Solar installer, et cetera. So generally, Vermont does have a worker cooperative corporation statute, which is C Corp like. A lot will just incorporate as a general cooperative with C Corp with worker co-op bylaws. And there are reasons sometimes that people will use an LLC structure, but usually it's a corporation. One key difference between this and a partnership is that the cost of membership is not based on the market value of the company. It doesn't go up or down. So with the ESOP, every year you do a valuation and the share price changes accordingly. With a worker co-op, it's more kind of a question of balancing enough to be real skin in the game so people are not treating it lightly, right? They've made a real investment in the company, but not so much that it's inaccessible to sort of folks who are on the lower end of the wage scale early in their career, don't have a lot of cash. And companies that do higher share prices will oftentimes have the option for folks to buy in gradually, like to put a down payment down and then pay in over time or something like that. Any profit, when profit is distributed to members, usually part is paid out in cash, and then the company can retain some as working capital within the company. And if it does that, then it keeps track of that in internal capital accounts for each member. And so when a member leaves, the thing the co-op owes them is essentially the share that they paid in. So it's usually at face value. So say it's $5,000 in, the company will buy their share back for $5,000, plus any of that accumulated profit from the time that was kept as working capital by the co-op while they work there. And it can usually be paid out over time. And in terms of people joining a co-op, there's an eligibility period. So this is a little bit different than that vesting thing we talked about with the ESOP. But basically it's defined by the bylaws, and it's basically, usually the consideration is how long do the founders feel like someone needs to work at the company before they feel like that person's a long-term good fit that they'd be comfortable being a co-owner with. There's some companies that have high turnover where it's like, oh yeah, it's at our coffee shop, if someone's here working there for a year, like that's great, and we'd love to keep them around and happy to have them in the ownership group. There's others where it's like, okay, we want to see, say, people work through a couple of different project cycles, and it's going to be like 3 years or 5 years or something like that. So it really varies by industry and by just company in terms of what that period is. But generally, someone will work there for that period of time, and many co-ops will actually sort of have the requirement that if they meet the eligibility period, because they're wanting to build an ownership culture, someone needs to join unless they have a compelling reason not to. And people need to be, their applications to join need to be approved by the board of directors. That's kind of one of the jobs. The board of directors is to say, okay, do we feel comfortable with this person coming in? Do they need to do some more work before we feel comfortable? Is this a time to say, all right, well, you've been okay, but not ownership material, maybe it's time to part ways. So this is just kind of a quick diagram of how kind of worker co-op governance works, right? So you have the membership, everyone who's bought in, they elect that board of directors. And companies that are under 10, you oftentimes that board of directors is everyone, and maybe meet quarterly to just review financials and updates and policies and things like that. Bigger co-ops, it's going to be more defined group. right? And they select a general manager or CEO, and give them certain strategic direction and will be responsible for their compensation, that sort of thing. And then that management has the power to hire and fire employees. And one of the things that's important to remember with employee ownership is, you're an owner, but you're also an employee. So an employee owner can be fired for not doing their, performing their work effectively. So there's like 4 ways in which worker co-ops come into being. And so it's a little more varied again, because it's a lower overhead model than the ESOP. So there definitely are startups. So for instance, the newest co-op in Vermont is the Culche Wine Cooperative, which was founded by 3 women who were, 2 of whom had worked together at another business. That business went out of business. They decided they wanted to start a winery together, and they liked the idea of starting it on this basis. So, they kind of went through the classic startup process, but used this structure as the basis of their business. And I think they're having their first tasting at Switchback in a couple of weeks. So that's been an exciting one to watch for us. The second is kind of rescue. So, there's a business that's closing or has closed. There's a group of employees that have worked there in the past. They assess that the reason it closed was not a, fundamental kind of flaw in the business model, right? The business model's valid and good, but, say there's a health, something happened to the business owner, and, they were unable to really manage it effectively. And so it just kind of went down the tube. So kind of coming together and kind of reopening a business as a worker co-op with new financing, that sort of thing. The third is kind of strike, is where a group of employees who are dissatisfied with their current place of work, decide they want to go into business together on this basis. And we've seen a few of those where, there's some folks who've worked together at various places and, had never really found a place that they were fully happy with how it was run, decided to start something of their own and, have control over how it was actually working. And then the final, and this is probably what we do most of our work with, is ownership succession, right? So an owner of a conventional business sells to the employees, they've looked at their different options, they get their valuation, and they decide to go through a co-op. And so in terms of exiting to a worker co-op, thinking about this as an exit path, there's a couple of key questions. One is just, are employees interested and excited about the possibility, right? There's some cases where just employees are like, I'm happy to be an employee. This is come to work, punch the clock, do my job, get my paycheck, not take any further stress home with me. That's good enough, right? So, but and there are other cases where, people are gung-ho about this. So, really that's the first kind of metric. The second is, is the group capable of taking on the buyer role? Oftentimes there's this asymmetry between a business owner who's been looking at the books every week for years and years and years, and a group of employees who, are very good at their jobs, but, don't know how to read a financial statement. So this one's more of a kind of, you assess in the short term, but then also what are the resources available for helping them build that capacity? Oftentimes we will see kind of initial interest, and then the employee group will work with the Small Business Development Center, which provides free business counseling to work up a business plan and do some kind of like, some financial modeling and help them look over the valuation as a kind of third party set of eyes. And there, and other sort of resources that can say, okay, maybe it's not now, but if there's interest, then here's the work that can be done to get them to the point of being interested in buying. Third is, of course, management succession. This is for any sort of ownership succession. This is a big one. Is there an opportunity to, how much of a gap is an exiting business owner going to leave, and how much has been filled in the meantime? I think that's a big consideration, is an important thing to just kind of work through and plan. And again, it might be one of those things, all right, we don't have that in place now, but let's focus on that in a year or 2 years, then we're ready to do that. And then finally, of course, is the business saleable at all, right? In terms of debt load, collateral, state of the industry, just really assessing, is this a good idea for the employees? And those employees are also having some support in assessing that if it's something they really want to do. So the final model, and I've just got one slide here to talk about briefly, is employee ownership trusts. So this is something that has been very common in the UK for a long time. And there's been changes in American trust law that's allowed this to become more common and workable under American law. So for a very long time, the only thing in America that you could create a perpetual trust for was a cemetery to put money in, and for forevermore it will pay for the lawn mowing and that sort of thing. There's more flexibility now in creating what's called these kind of perpetual purpose trusts that can do a wide variety of things. But one of them, and this is something that's a lot in the UK. John Lewis Partnership is a big department store chain that created this in the 1920s, and it's probably one of the most famous examples of it. Is basically a trust where the purpose is to steward the company and for the benefit of the employees. And so you basically, this trust is created. It's basically, there's no kind of equity ownership of the company directly by the employees in the same way as with a worker co-op or an ESOP, but rather employees might have governance rights to the trust, and the trust will kind of distribute profit to the employees each year. So this is something where it doesn't have the same tax benefits because it's so new as these other models in terms of for selling owners and that sort of thing. And it's usually 100% seller finance, just kind of due to tax considerations. But what it does allow for, and this is a model that folks are very strongly interested in kind of maintaining a company's independence and or commitment to certain mission elements. This is probably the strongest mechanism for doing that, in that you can kind of write into the trust document that say the company will always provide, send a certain amount of its profits to support certain causes, or it will only sell under sort of certain circumstances or won't sell at all. And if it's sold, the proceeds are going to go in this way. So it's a certain slice of business owners for whom this is really interesting, but for those, it's probably the most powerful tool. And it's something where it's kind of in between the ESOP and the worker co-op in terms of cost. It's going to maybe cost $10,000 to $30,000 to set one of these up, and you don't have to do the annual valuation and those other things, so the kind of carrying costs are much lower. So with that, that's kind of again, quick high-level overview of these models, and certainly always happy to kind of entertain email questions, or we do an annual conference that gives some big deep dives on June 9th is when that's happening. But we'll move kind of from more of the abstract to hearing a little bit about employee ownership in action, from the experience of Stone Environmental. So just to recap before that, again, ESOPs, great for bigger companies. They want to preserve the business operations, provide prosperity to the employees, engage employees, that sort of thing. Worker co-ops, are doable for much smaller businesses, lower setup costs, lower carrying costs, require more kind of direct involvement, both financially and governance-wise, from the employees than an ESOP does. And EOTs, or employee ownership trusts, really for larger businesses usually, but large to medium size, that want to preserve their independence and or kind of mission commitments, and while benefiting employees in both in terms of involvement and that sort of thing. So I'll pass the mic over to Nick. Oh yes. Question from Julia before I pass the mic.
All right, I just had one question about the worker-owned cooperatives. What are the sort of the range of costs to set that up?
So, it depends on if you're kind of doing startup versus a sale. With a sale, it's going to be something along the lines of you're going to want to get a mid-range valuation that's going to cost you maybe like $2,000 to $5,000, especially if there's outside financing. Any outside financing will want to see a valuation report to kind of confirm the price that's being paid. And then there's some support and legal costs. So I'd say probably a reasonable budget for something along those lines would be, depending again the size of the company, if there's outside financing or if there's seller financing, anywhere between maybe like $7,000 and $15,000 would be a budget I'd put in. And then for a startup, a lot of it can be kind of done more on a shoestring, because you're not having to establish an existing value. So it can be a much cheaper thing if you're like, okay, there's a group of us who want to come together and form one of these. Then it's more kind of just part of the corporate formation process with some nuances to it. All right, so
thanks.
Passing to Nick to talk about Stone.
All right. So yes, my name is Nick Floersch. I work for Stone Environmental. That's our building. You probably have driven by it a bunch of times in Montpelier. We're the top floor and part of the half of the middle floor. And yes, we have a lot of company outings to both the Hunger Mountain Co-op and to Sarducci's. So because we're right smack between them. I figured before I go into some of the details about being an ESOP, I should introduce who we are a little bit more. This won't be too long, but we were started in '92 by Chris Stone, thus Stone Environmental. And they were initially doing agrochemical fate studies, what happens when you spray agrochemicals on soil and watch it over 5 years. What's the fate of the agrochemical, which is related to the FIFRA Act that came out in the 90s. after various political changes and the FIFRA Act came and went and came back and went and get, they decided to diversify the service lines. And so we ended up, we're now at currently at 5 service lines where we do agrochemical fate work, environmental assessment, remediation, go to a site, see what kind of toxic stuff has been spilled there, how to fix it. We do water resource work, which is both stormwater and septic design for municipalities, and I guess for rich individuals potentially. In environmental modeling, and so instead of going to the field and spraying a sample patch with poisonous weed killer, see what it would do if you can model it instead. And then geospatial and data solutions, which we basically boil down to calling the GIS group, which is where I work. I've been with Stone since 1997. And have seen the transformation through all that time. It's been quite a ride. We have worked all over the world. Personally, the farthest abroad that I've had work involvement was in Malibu, California. But some of our employees have done work in Australia or in Europe. Currently, we're at 50 people. We've been bigger, we've been smaller. That's where we're at. And the process to become an ESOP started in 2016. Also, why are we in the VTTA? Since that may not be entirely obvious being an environmental consulting company. The geospatial and data solutions team specifically is basically a software and web development team focused on GIS applications, database-driven applications, desktop applications, more so in the past, and GIS stuff involving ArcGIS and doing a lot of Amazon Web Services work and hosting and such. So that's why we're in the VTTA. So we have an ESOP now. It's pretty cool. Why? Why do we have it? It kind of all started in 2015, I think, when we had a branch of the company that didn't really fit in. It had grown very large and was very valuable, but at the same time, it didn't seem like it matched the rest of our service line. And so we had received a bid to buy it and basically sell it to an out-of-state company. And because we didn't really want that branch very much, I mean, we liked the employees, but the actual business itself wasn't a good fit. We were looking into selling it, and we did. And in the process of doing that, we started to question, well, what's to stop the owners from selling other parts of the business and moving employees out of state or whatnot. So that was coinciding with Chris Stone and David Healy starting to, who were two of the principals, starting to seriously look at retirement. And so it was really a succession question. The guy who was handling the process of selling the branch of the business that we wanted to get rid of knew a lot about ESOPs. And so he kind of guided us in that direction. And it felt like a good fit. So Chris and David's, I think, concerns were around how do we keep the business effectively the same, which is to say, it feels like a big family. It's collegiate and respectful. The shared values were very clearly understood by people that had been there a long time and wanted, you know, David and Chris really wanted that to persist. So instead of it just being on their shoulders to keep making that such a thing, they figured we could explore the ESOP as a way to really formalize everything about who we are and put it on everybody's shoulders. And at the same time, it was a privately owned company, and there wasn't a very clear or transparent explanation for who had a stake in it and where, you know, who were the shareholders. It was never really well known who the shareholders were. It was certainly not all of the employees. It was just, I think there were 10 or 11 total. And it felt like if we were starting to look at ways to let David and Chris retire, how could that shareholder experience be expanded in a way that made it fair to all the other people that were not shareholders that had been working so hard. So Stone got a loan and bought out the shareholders, the previous shareholders. My understanding is that that was well received by the shareholders, and eventually we paid off that loan. This is something that Matt had talked about as one way to get those shares, and we had a big celebration. So that's kind of the background on why we did it. It's funny, but I don't always have all the perspective on being an ESOP. I have some of it. So I asked some of my colleagues a little bit more about various aspects of being an ESOP, and I asked some of these questions. One person wrote that she says, I guess my one comment after going to ESOP conferences is that I think some of the reasons that some of us didn't feel like it was a huge change is because, I mean, it was a change, but it wasn't a huge change because we functioned a lot more like an ESOP already than a lot of the companies that she's talked to. And she thinks there's a case that a lot of Vermont companies don't act like traditional one-person owned companies who tend to be really private about all the moves they're making, which is true. I mean, Stone before an ESOP was not highly transparent, but I don't think it was intentionally untransparent or opaque. It just wasn't something that was as built in. So after talking to some of those companies that were more private intentionally, it was a very big culture change and structural change for them to do that and move to being an ESOP. But that at least for Stone and it seems like other Vermont companies that our employees have talked to about this, it may be closer to just formalizing something that's already there. So in the process of becoming an ESOP, we went through and reestablished their vision and mission, which is something that, the Stone had established in the 90s and then maybe reaffirmed in the early aughts. But we decided to get all of the new employee owners together and rewrite our vision and mission so that we all could agree on it. We broke out into many different teams and put a lot of feedback in so that absolutely every employee was giving their input on this process. And kind of reaffirmed our values. This is company meetings, and something that's changed based on the impact of the ESOP is that in the past, the company meetings felt like it was this communication between management and the rest of the employees, or vice versa. So it would be either management polling the rest of the employees through some various information gathering sessions at a company meeting on what priorities need to change, what things we need to start exploring, what we've heard from customers. And then on the flip side, it would be, management telling us what we did need to do and how we were going to do things. So that's different now because even though there's still managers and non-managers, we all feel more of a sense of equality with each other. And so the company meetings are much more of a real collaborative process, or it feels more collaborative, even if maybe the structure hasn't changed significantly, it feels more collaborative. Employees also still have 401ks as well as the ESOP shares that we get, and it's a real driving thing to see that your work that drives the stock value of the ESOP shares, it's making the link between what you do and your retirement benefit value versus the 401k, where it's like you can just only put in so much, and however much you put in is how much is there. So people get that sense of connection. And I asked, as I said, some people about this as well. One said, I can't say I really think about the ESOP on a daily basis, but I think it is one of the things that contributes to the general feeling that everyone at Stone is on the same team and that we are comprised of people with the shared values and goals. Another person said that I guess I still put myself in the newer employee category, but it's pretty cool to see the account balances change from year to year as we get our contributions. It's not something that I had in my previous job, and it does motivate me. I also like that employee ownership and Stone specifically give employee owners the opportunity to engage in making Stone a better place to work in ways that just wouldn't be possible at other jobs. The ESOP committee, as an example, has been a great place where we could test out certain ideas and learn about business finances, ownership culture. So when it comes down to the learning part of it, I think as Matt alluded to, can employees take over ownership of a business? Well, certainly if they don't understand finances, business finances, it's going to be harder for the transparency of the finances to have any sort of driving value. So there's been a whole lot of education over the years now where we try to make it clear both what how the ESOP works and what its value is, but then also just how the business works. And we're having a staff meeting today. At every monthly staff meeting, we see very transparent financials for how we're doing. And maybe the newest employees haven't gotten fully educated on reading those, but it's something that most of us that have been there for a while now understand, because understanding it helps us understand how our work is really driving those numbers better. It's not just the manager saying do a better job or you're fired. It's seeing those numbers attached to your retirement fund. So there's also ways in which having that education makes it more powerful to do things like have earnings games and pushes, so that, if you want to have a game where you can reward, let's say, the group that makes the most money in a certain period of time and most revenue or profit, whatever they want to drive around, those games have more of a direct value because we can see the numbers and we understand them more, at least. I also understand from talking to people in hiring committees that I've been on, as well as other employees that have gone through hiring processes, that it is a draw to bring new people in when they see that they would become an employee owner. The vesting, you're not immediately fully vested, as Matt was indicating. There's a few years. You go from 0, I think 6 months is when you start really getting contributions or something, and then up to, I believe, 3 years. Someone wrote that we do these things called a brownie for your thoughts, where someone on the ESOP committee will reach out and try and offer a brownie to somebody else in the company to sit down with them, like over a coffee break or something, and just talk about how the business is doing, how the ESOP is doing. Someone said that my experience from conducting brownie for your thoughts interviews and just talking to folks is that being an ESOP is definitely a draw and makes us attractive to potential hires. And we also have heard that this is the case for other ESOPs in Vermont when we've gone to some of the conferences. So it seems that there is a value in connecting, seeing the stock share price, and letting employees know that they're driving it directly, and that this is really how we can represent their ownership in a very tangible way. We put together this Bill of Rights to make sure everybody knows what it means to be an employee owner, both the rights and responsibilities. And the ESOP committee represents the culture beyond just education and pushing, people to know what an ESOP is, but to say, now that we're an ESOP, we have these shared values. How do we reinforce the shared values? How do we how do we go back to the mission, the vision, the values, and do work together, celebrate together, acknowledge together things that will reinforce those values. So the subcommittee's done a number of things over the years. They constantly share educational webinars that are happening, whether it's from them or that are just shared publicly on the internet, such as this one. For new employees, every period of time, new employees will be invited to a ESOP welcome breakfast. We finally got a feedback box. We never had one before the ESOP. So if you had feedback, you either bit your lip or you go to the boss and say it directly. But now it's much more transparent. The employee owner's manual is now a thing. So it describes exactly how the ESOP works. If you ever have questions, you go back to it. It's got a whole lot of question answer things in it as well. We do annual surveys of engagement by the employees, as well as the employees all decided that we wanted to engage in best places to work, the best places to work thing as well. So we have kind of two judgment or whatever gauges for how people are feeling about the work. We send members of the committee to national and Vermont conferences, and we do vesting recognition. So when you become fully vested, you get a vest, which I'll have to stop my share for, I guess, but get a vest. There's different designs. Mine was this Patagonia thing. It says 100% vested on it.
That is just so cute. I love that.
Been there forever. What else? It's kind of like the last slide, but let me go back to it because I don't remember it. Right, the brownie for your thoughts. And then what used to be an annual meeting, which was effectively all of our annual strategic planning in one day. We've now taken the strategic planning thing and spread it out into a collaborative, non-single day process. And the annual meeting is really, it's about the ESOP, it's about the employee owners, and making sure that new information about being an ESOP, changes in ESOP understanding, I guess, and what our annual stock valuation is, are all shared in that place, and then it turns into just kind of a company party picnic thing at the end. So again, it reinforces the ESOP, it reinforces values, and engages people with some games and fun tied into it as well. And I think, yeah, that's kind of all I really had to share. But let me see if I had any other. Just going through my notes real quick. I don't think so. Yeah, that's pretty much it.
Cool. Well, thank you, Nick. And yeah, if anyone has any questions you want to throw out to us, I'll also throw up just a slide here quickly that just has some resources, websites, and contact information for us. But yeah, just open the floor to any quick questions here.
Nick, how do you determine who is on the ESOP committee? Is that a voting?
Yeah, it's in the ESOP manual, so it's pretty clearly defined. And basically, there are 3 individuals who are kind of permanent ESOP management staff in the company, and 2 of those 3 go through 2-year rotations before it kind of comes up again, and they pick 2 of the 3 to be part of the committee. So there's 2 of those 3 are on the committee, and then each of the service lines has 1 representative, so that when the ESOP committee is trying to accomplish something, there can be a line of communication between the committee and each of the service lines, which also includes, I didn't mention, like we have a foundation service line, which kind of just supports all the other service lines with HR and billing and that kind of thing. So that's the structure. And then again, every service line's representative is kind of on a 2-year rotation unless they leave. And I would say also that getting to Matt's point about turnover, of course, employees come and go. I haven't seen nearly as many cases where the employees are leaving because of some kind of disagreement with the their manager or something about company value or whatever. It's mostly been logistics. Like my husband got a really great job in another place, and then we're like, can we retain this person remotely? And if it doesn't make sense, then we can't. And so yeah, the turnover has also changed a little bit in that sense.
Any other questions?
I don't have a question. I just wanted to say thank you. This was really helpful for me. And I realize I have a lot of work to do and a lot of growing to do before any of these structures are appropriate for my company, but it's really great to have this on my radar. So thank you, Matt and Nick.
Yeah, I mean, thanks, Matt. I mean, our members range from, 2 or 4 person companies up to, 20 and 50 or larger. So there's lots of variations here, obviously, that folks can look at. And I assume besides this, there's you to contact in the organization, right? So. Right.
Yep. No, definitely. In terms of, feel free to shoot me an email if you have any specific questions. Matt@VEOC.org with two T's. And then, we also, so we're always happy to do consultations. And I mentioned and Nick mentioned a little bit as well. So we do an annual conference every June. So it's June 9th that brings together folks from existing employee-owned companies, but also as a track for people who are exploring employee ownership. There's experts both on kind of ESOP and worker co-op structures. And more recently, we've had sessions on EOTs too. So that's, if you want to do like a deep dive and talk to more people who are actually doing it, that's probably the biggest gathering of employee ownership folks in Vermont each year.
Sure, we'll have somebody there.
Great. Okay, well, thank you, Matt and Nick, and for others, check our website for upcoming webinars, both ours and others at VTTA.org, or actually subscribe to our communication distribution for other things that are happening. So
yeah, and I'll send along the recording, so a link to the recording, so you can send that out to folks.
That'd be great. Thank you.
All right.